Welcome to the Rigden Financial YouTube channel. My name is Mark Whaley, and today is March 9th, 2022. I'll be asking Laith Matthews, President and Lead Planner at Rigden Financial, about investments, interest rates, and other helpful topics to assist in your financial planning. Laith, today I wanted to ask you about what your thoughts are on the current investment environment, but particularly about defensive investments in these particularly uncertain times. Can you tell us your thoughts?
Yes. Well, the last uh, few weeks or months or years, there have been a few things to worry about. The more you reflect back, you realize that actually there's been stuff to worry about for a long time. And so the topic of how to invest in uncertain times is either passé or very appropriate all the time
Right.
because uncertainty is always with us. But there are a number of things you can do to try to minimize the extremes. And that's really all you can do as an investor, because the nature of investing is taking on some risk in the pursuit of some higher rates of return. And the skill or the goal is to not take on more risk than your potential return merits. So anyway, how would you go about doing that? Um, the current investment environment is particularly tricky because we have this war going on in Ukraine, and that's kind of spooky. There's all kinds of commodity movements going around, and we could talk about that later. But generally, the most straightforward way to mitigate risk in a portfolio is to diversify. So you diversify both by asset classes. The three main asset classes would be cash, bonds, and stocks. Cash is just money in the bank. Bonds are investments that just commit to paying you a certain level of interest over a long period of time, long or short. And stocks can be anything. So you can sort of boil it down to those three asset classes, just simply because stocks can represent everything, like from real estate to commodities to financial businesses to industrial manufacturers. So first thing is you might diversify your money into those three categories. Then within the stock portfolio, which is generally going to be the most volatile, you can diversify by management style. Well, first of all, you can buy a fund. You can buy a mutual fund or a segregated fund. And this is a huge advantage right away, because you're diversifying among potentially hundreds of different companies. And any individual company, if you're lucky, you'll buy Microsoft at $250 and it'll go to 250,000.
Right.
But that's really like buying a lottery ticket. And we'd all be richer than Bill Gates if we knew how to, if we could be sure. So
Gotcha. Yeah.
the alternative is you take a little risk with a lot of money and you divide that money up. So that's diversification. And then you can also put some of the money with investment managers of these funds who have a certain philosophy. There may be different philosophies. One philosophy might be very value oriented, so they scour the stock market for bargains. Another investment manager might be very growth oriented, so they're trying to get their money into the companies that are growing the fastest, like Apple and Google and Tesla and those kinds of companies. So you might combine those two investment philosophies in your portfolio. Last but not least, you want to globalize your portfolio, and that's because it's a global market. Things are changing all the time. Canada, for example, is heavily commodity oriented. So we do well at certain phases in the economic cycle. You can't always predict when those are coming or whether the stock market already reflects that, but there are certain times when Canada is a place to be. But if you diversify, you can participate in a lot of different trends. So anyway, so that's the first thing. cash and bonds are usually the safe haven assets, and people have been sort of interested in those. Normally, you might go to that. It's a little bit trickier now. There's been a lot of criticism of bonds lately because interest rates are very low. And when interest rates go up, a bond that guarantees a lower interest rate will go down. So you can lose money in bonds temporarily. If you hold it to maturity, you won't lose any money, but who wants to do that? You want to make your money. So, and also because of the pandemic, governments have been using monetary policy and fiscal policy much more proactively. They've been creating new money. Basically, they lend money to the banks very cheaply, and the banks just flood the economy, and that keeps people employed through the pandemic. Sort of, it's an employment strategy, and that's been good, and it's kept people from a depression. On the other hand, if you're pumping that kind of money into the economy, you get some weird things like the real estate boom has kind of gone wild. You get inflation, and I'm not sure how we back out of that. So what Warren Buffett says is you should buy productive assets, that's the safest place to put your money. So that means stocks. In other words, buy companies that are proactively looking for opportunities and position themselves intelligently. The way I translate that is never underestimate the ability of human beings to make a buck. Because we're very inventive and we're always anticipating. So why not pay somebody else to do that for you? On the other hand, the role of having cash and bonds in the portfolio dutifully is that you can do rebalancing. So the value of it is temporary. So cash and bonds don't do much for you long term, but they're really valuable in the short term. So if you have a fund that automatically transfers for you, or if you yourself will systematically meet with your advisor and rebalance periodically, then what happens is you end up buying low and selling high. So if the stocks are way down, you're rebalancing to the original asset allocation, and then you put more money in stocks. If stocks are way up, well, maybe it's time to take a little bit of those profits and move them over to bonds. If you buy a fund that does that for you, it's going to happen automatically. This is a very nice thing. If you're if you're drawing income from your investments, that stability is even more valuable. Just because the nature of drawing money from a portfolio, you really need stability. It's very valuable to you because you could be selling at all the wrong times and things like that.
So does the automation help me with that if I'm drawing funds?
Yeah, it's going to give you stability because every time something goes way up, there's going to be some of that gain is going to be shifted over to the other asset class. So you just have to, the critical thing for all investors in hard times and good times really is to identify an asset allocation, whether it's 30%, cash and bonds and 70% stocks, or maybe it's 35 or 40% cash and bonds and 60% stock. Find an allocation with the help of your advisor that you can live with and you can sleep at night. And then it's the next thing is, how is it rebalanced? So you can automate this, which is a really nice thing to do, or you don't have to. If you're a longer term investor, you can start out with an allocation, a balanced allocation, and then let your winners run. And in the long run, what will happen is your stocks will tend to dwarf the value of your cash and bonds because they'll grow faster, but you'll experience more volatility in the short run. And if you're able to withstand that, that'll probably be the best long-term rate of return. But if you're drawing money out, you really need that stability because otherwise the value of your portfolio can go down quite rapidly in a down market. So anyway, that's probably more detail than you needed.
Great. So what does that mean for mortgage borrowers right now? You talked about the housing market a little bit, but how can you advise us there?
Well, the particular circumstances in the world right now are make this really complicated, because what we were seeing before Russia invaded Ukraine was a kind of a clear indication of inflation that was sort of influenced by the monetary policy to bring us out of the pandemic. Now, what's happening is we have commodity prices going up potentially. Like, look at oil prices; they're zooming way up. And what you have to understand is that a strong rise in oil prices is equivalent to an interest rate hike. There's even, economists out there that do the math and say, well, if the oil goes up this much, it's the same as if the Federal Reserve raised the rates by a quarter point or a half a point. So that means that the central banks will be a little bit slower. They will be a little bit more cautious about jacking up the interest rates. So again, variable rate mortgages may be better because the central banks can keep those prime rates down. On the other hand, the fixed rates, which are more internationally determined, they may continue to rise. But anyway, I'm not as worried about interest rates actually in the short run, because we have so much uncertainty in the world, and the banks don't want to make it worse. I mean, the central banks, yeah. So,
Right.
yeah, that's what's happening. So, to make a long story short, investors really should probably be how shall I say? They should probably be buying. There's a famous line from Baron von Rothschild, who started one of the famous investment banks in England, who said, "The time to buy is when blood is running in the streets." That sounds a little bit morbid, and so anyway, I I regret that. But I will say that, even when there are other types of scares, in general it's probably safer. I mean, think about it. The NASDAQ index is down 14-15% from the beginning of the year. That's a lot cheaper than it was on December 31st. It's safer to buy at a 14% discount than it is to buy full price. So
Right. Yeah.
that's how that goes.
Okay. Well, thanks so much.
Yeah, you're welcome.
All right. Until next time.